Welcome to This Explainer. Today, we're diving into a massive, honestly kind of striking paradox that's defining the global economy as of June 30th, 2026. Right now, we are looking at a landscape where soaring financial markets and these massive corporate mega deals are completely masking a deeply cautious, grounded reality for everyday workers. We're going to unpack exactly what the data is telling us right now and why understanding this split screen is absolutely crucial for your own financial moves and your career decisions. So, on one hand, we are seeing ridiculous levels of corporate exuberance. Just look at this mind-blowing number. We're talking about an $8 billion space acquisition that just hit the wires. Companies are out there making bold, incredibly expensive bets on the literal edges of our atmosphere. But hold on a second. Let's contrast that sky-high optimism with a much more grounded number. 19%. That is the current worker quit rate. It's a historically low figure that has been hovering at or below 2% for almost a year now. And you know what that tells us? It shows that while corporations are launching literal billions of dollars into the stratosphere, the average worker is, well, they're basically clinging to their desk chair with white knuckles. Despite a ridiculously hot stock market and strong corporate spending, people are terrified to leave their current jobs. They're just hunkering down. Okay, let's get into Section 1, the high-flying markets. We're talking AI, record quarters, and the space race. You've probably felt this in your portfolios. The S&P 500 and the Nasdaq just posted their absolute best quarter since 2020. The S&P closed out the quarter at 7,498, and the Nasdaq hit 26,194. This massive surge is being driven largely by just insatiable AI infrastructure demand and heavyweight tech companies like Micron Technology, which just posted some outstanding earnings. I mean, investors are pouring unbelievable amounts of money into memory chips, GPUs, data centers, the whole shebang. And what's really wild is how this brilliantly illustrates the market's resilience. These financial records were achieved despite some very serious, ongoing geopolitical events. For instance, even with a June 17th Memorandum of Understanding aimed at ending the conflict between the US and Iran, we still saw exchanges of fire over the weekend. On top of that, high-level meetings in Doha have stalled out. Yet Wall Street? They've largely just looked right past these tensions, keeping their focus squarely locked on corporate earnings and economic growth. And taking that market exuberance literally into orbit, Rocket Lab just announced an enormous $8 billion cash and stock acquisition of Iridium Communications. Why? Because Iridium holds this highly coveted L-band spectrum network. Like Rocket Lab's CEO Peter Beck pointed out, this spectrum works through all weather. It reaches the gaps where other bands simply can't. That makes it absolutely mission-critical for aviation, maritime, and government communications. So the crucial takeaway here is that this acquisition isn't just about regular expansion. It's literally an $8 billion shortcut. Building a satellite constellation from scratch, that takes years to generate cash flow. By scooping up Iridium, Rocket Lab gets to instantly compete directly with SpaceX, who, by the way, is right in the middle of a $17 billion deal involving EchoStar, and Amazon, who has a major partnership with Globalstar. Corporations are aggressively spending billions to win this modern space race. All right, coming back down to earth, let's look at Section 2, the labor market disconnect, job openings versus worker confidence. So, according to the May JOLTS report, we are facing a totally fascinating labor paradox right now. On the employer side, demand is actually surging. We're seeing a 24-month high with 7.6 million job openings. But then you look at the worker side, and the quit rate is essentially frozen solid at 1.9%. Normally, workers tend to quit when they feel confident they can find something better, right? But right now, despite those millions of openings sitting out there, the data clearly tells us workers simply do not feel confident enough to jump ship. And when we break down exactly where those openings are, the picture gets a lot clearer. Sectors like wholesale trade and food services, they added tens of thousands of openings. But your white-collar sectors, places like healthcare, social assistance, finance, they actually shed a combined 184,000 job openings. Now here is the real kicker, the most telling data point. Total hires remained entirely unchanged at 5.2 million. Think about that for a second. We have 7.6 million job openings, but hiring isn't actually increasing. That means the employment gains we're seeing in the broader economy are being driven almost entirely by a historic drop in separations. People are just flat out refusing to leave their current jobs. Moving right along to Section 3, global shifts and new rules. We're looking at the macro and regulatory undercurrents here. If we zoom out and look internationally, the data points to a very cautious, somewhat fragmented expansion. Over in China, manufacturing just ticked up to a 50.3 PMI, catching some really strong tailwinds from green energy and AI exports. Up north, Canada officially exited a technical recession with 0.5% growth. In the Eurozone, inflation is slowly but surely easing to 2.8%, and the UK saw a modest 0.9% year-over-year growth in Q1. So the global engine is humming, sure, but it's humming very cautiously. Meanwhile, over in Japan, the yen is currently sitting at roughly a 4-decade low against the US dollar. And get this is happening despite the Japanese government plowing roughly $72 billion into shoring up the currency this spring. It's just a stark real-world reminder of how incredibly powerful macroeconomic currents can be. They can overwhelm even massive, multi-billion-dollar government interventions. Bringing it back stateside, the financial world is hastily adopting to some brand new rules. The SEC just dropped the 2026 exemptive order for non-convertible debt securities. This officially supersedes the old 2015 no-action letter. Basically, what this does is allow companies to maintain a highly regulated 5-day tender offer period rather than waiting the standard 20 days. And in modern corporate finance, that kind of speed is absolutely vital. But, of course, there's a catch. To actually utilize this abbreviated 5-day window, issuers have to navigate some incredibly strict guardrails. The offer has to be strictly for cash or qualified debt, it's restricted solely to institutional buyers, and, this is a big one, the issuer cannot be facing any defaults or bankruptcy proceedings. It's essentially a way to let healthy companies move fast while keeping the regulatory guardrails firmly bolted in place. Finally, let's wrap up with Section 4, Navigating the Second Half. What to watch in Q3 and Q4 of 2026. So, tying this all together, the broader economic landscape really remains this incredible tale of two realities. On side A, we've got sky-high corporate exuberance. We're talking massive AI investments, an $8 billion space M&A deal, and a wildly resilient stock market. But over on side B, we're seeing intense ground-level caution. You have workers paralyzed by a 1.9% quit rate, consumers really straining under tight budgets, and companies carefully navigating some very complex new regulatory environments. As we look ahead to the rest of the year, the market's focus is inevitably going to shift from all these grand promises of AI to actual, hard financial results. We'll be watching the Q2 earnings releases super closely, like United Community Bank stepping up to report on July 21st, to see if the ground-level reality is finally catching up to the market hype. Plus, traders are actively pricing in potential Federal Reserve rate hikes later this year, which, let's be honest, could completely shift the balance of this entire equation. Which leaves us with one final, pretty provocative question to ponder as we wrap up this explainer. With corporate markets literally reaching for the stars, yet everyday workers staying safely grounded and refusing to budge, what does this disconnect actually mean for your own portfolio, your investments, and your career in the second half of 2026? It's definitely a question we all need to be asking ourselves right now. Thanks so much for joining me, and keep learning.